All right, everybody, welcome to another episode of the Mike Norman MMT podcast. We're doing it visually today. Look at this, and I have a guest. I actually have a guest, my good friend, Matt Franko. He's a contributor to my blog, Mike Norman Economics.blogspot.com. Very, very smart dude here. I have to say, he has come up. And we've known each other for like 15 years or something like that. You used to be a follower of my radio show. This is the first time we're ever really seeing each other face to face. But I always say my smart friend has come up with some very, very unique insights that nobody else seems to pick up on. And they've been very prescient and very, very smart. And it has given us, different angles on the markets, and particularly with respect to Fed policy and monetary policy. But we're going to get into that anyway. Matt, thanks for coming on. It's been a long time, buddy.
Nice long time.
We talk a lot, but first time we've ever seen each other. But anyway, thanks for coming on. I want to start off. Let's start off just. You got involved with, following my radio show back in, I don't know, must have been like 2004, 2005. And I was talking about a lot of MMT concepts, things that, prior to that, maybe you had no exposure to. So just bring us up to speed on that.
Well, I think I think your show used to be called The Economic Contrarian. And I think before, I don't know, I just sort of was personally interested in investment throughout the 90s and into the 2000 decade, and started to understand the value of contrarian investing. And that I think the name of your show, Economic Contrarian, it kind of, I said, I need to listen to what, I think he's onto something there, and drew me into that. And then it got more technical as you started bringing some of these MMT concepts into your media. So then, because of the technical aspects, as I would call them, that drew me in even more. And I just think it's a better way to approach investment and trading. If you're a trader, macro trader, it's a better paradigm, if you will, or a better conceptual approach to money and investing.
I've just, personally, I've always that's me. Like, if everybody is thinking a certain way, if things become a fad, if they become fashionable, I just automatically start looking for ideas, kind of in the opposite way, or get the sense that, this concept is completely, discounted by everyone believing in it, and that leaves open the possibility for, other facts that are being overlooked. And just, that's my nature, is to be contrarian. So I remember even when I was a floor trader, and I was a member of 4 futures exchanges and floor trader. That used to be my nature. The market was going up, I'd want to sell. The market's going down, I'd look for reasons that maybe it's going to be turning around. So, that was my nature, and I wanted to, do the show along those lines. And then I started to weave in the MMT concepts.
Well, you probably tested it in your mind. You probably saw that not work out, where the crowd would say, this is what's going to happen. And then you would go, okay, well, that's what everybody's saying, this is the way it's going to go. And then it doesn't go that way. So, you saw that and tested it and said, well, wait a minute, that might be a tip off, actually, that, depending on how big the crowd gets behind something, it could actually go the other way.
Also, oh, sorry, go ahead.
No, often, so you have to, a scientific, someone who's going to test things and wants to see it work out the way it's predicted, you're going to be repelled from that. you
And
know,
I found also in my time on Wall Street that, you know, there's comfort in numbers, but that's just true in life in general. You know, like if everybody believes something, it's much easier for a person or people to, you know, kind of latch on to that belief because they feel they have, you know, the benefit of numbers of many other people. You know, it's like people say to me, you know, well, um, if everyone believes like that, you know, how could you be right? But that's like saying, you know, you go back to the days of Copernicus, like everybody believed that the sun was revolving around the earth. How could you be right, Copernicus? You know, not trying to compare myself to Copernicus, but I'm saying like that's just a flawed critique. You know, that's like you know, that's a very weak critique to say, if everybody believes this, how can you possibly be right? I mean, those are the classic situations where there's opportunity or where something can be discovered, where there can be new innovation, like to think differently. And a lot of people have a hard time with that, you know, and there's also, like I said, the comfort in numbers. If everybody's wrong, and I saw this very clearly on Wall Street with asset managers and analysts, you know, hey, you can't blame me. We all thought this was going to happen, right? So it's a
right.
weak position, and you know, that was very, very prevalent.
Well, maybe you don't get fired, you know, because, you know, that you'd say, well, how could you?
Right,
Well, this is what everybody thought. You
right.
know,
You can't fire me.
right now, everyone is bearish bonds and thinks inflation is going to be non-transitory, and you know, we're going to be in this chaos forever. You know, and you can see the other thing, Mike, is now there's data available, you know, with the internet and with the government publishing these reports on the banking system, on the you know, the number of reserve balances in the Federal Reserve System, daily treasury statement, all that data on Fred system. You know, we have, there's more information available, so we don't have to get into this you know, just popularity contest, if you want to call it that. And then you get the, like you said, the herd mentality, protection in numbers. You know, you can be more technical about it today because of the prevalence of information.
Now, I'm glad you segued into that because, you know, you were the one who really kind of stumbled on the relationship between reserves and let's say, uh, what banks need to do or how they are constrained by that. Now we knew, you know, generally that, you know, reserves are not lent out. I mean, the MMT academic community, I mean, you know, they know that, they say that banks don't lend reserves. But you brought another aspect, or you brought some another level of clarity to this about how reserves affect, you know, what banks do, their ability, or how it constrains them. Actually, it's the opposite of what mainstream believes. They, you know, even central bankers believe, hey, we got to pump in reserves so they can lend it out, right? And that's completely wrong, because reserves fall on the asset side of banks, and then they need a certain amount of capital to justify those assets. And when central banks are doing, for example, quantitative easing, and, you know, piling reserves onto bank balance sheets, it actually constrains their ability to lend or take on other assets. Now,
Sure.
you
What
found out about that. You pointed that out, that, you know, several years ago. And actually, we started to trade off of that. You and I started to trade off of that on, you know, a monthly, weekly basis, basically. But why don't you talk about that? How you started to.
you did that in 2019, I think around mid, you traded it successfully. But the financial conditions, the regulatory conditions that year were very different than they are
Right.
now. So it made it, I think at that point, because in 2019, the Fed was keeping system reserve balances stable that summer. Remember, they in 18 they were reducing them.
Right.
Right, they're coming down, and then they stopped. They were reducing them around 50 billion a month or something
Right.
like that, and then Trump was getting all pissed off, saying, "Why are you taking the money out?" And then eventually, like in May or something, they abruptly stopped. And I think you traded it in July, and you traded it in August, or no, June and August. And you made that June of 2019 was like the best June since 1938 or something. Like you went long like June 6th or something, based on your monitoring these reserve flows.
Right.
And you got long. Everybody was like, "Oh, it's sell in May and go away." And then you said, "No, we're going to get long right here at the beginning of June for a month." And it was like the most bullish. It went up like 6 or 7% in 1 month.
Yeah.
So you get 2 of those months in a year, that's 12%. You're beating the S&P, and you're only invested 2 out of 10 months. So that was really powerful that year, because I think you made 7% in August or something. The same thing happened, but then quickly in September, they had that debacle where they were reducing reserves so much they went right to the limit of their 10% reserve requirement.
Yeah.
And then all hell broke loose, and they said like, they said like,
But think about that for a second.
Dried up, or something.
And they did it. Like, here's
Right.
the Fed, who enforces these regulatory mandates, right? I mean, they're the chief regulator of the banking system. And they're the ones who say, okay, you got to have a 10% reserve ratio. No, so it's 10% reserves to deposits. I don't think that's in existence now. I think they got rid of it. But at that time, it was. And they were reducing reserve balances down below or right at their own threshold.
It was right
putting banks in potentially a situation to be, non-compliant with their own regulations, the Fed's own regulations. Like, what? They're asleep at the wheel. What were they doing?
Well, could you go to share screen?
Yeah, go ahead. You got it, right?
Let's see.
You should have it.
Yeah, there you go.
There we go.
All right, let me pop over here to, this is, here you go. This is their H41, right?
Yeah.
Here.
Oh, here we go. September 19th, 2019.
September 19th, 2019, right?
Right.
So you could see here, reserve balances with Federal Reserve banks. That's on Wednesday, September 18th, right?
Right.
Right here, Wednesday, September 18th. It's 1385. Now,
yeah, 1.4 trillion roughly.
But Tuesday, they did a quote emergency $75 billion reserve add. Okay, so the day before this, right, they added an emergency.
They had to.
Right. So that takes that down to 13 it was 75 billion, 1310.
Yeah.
And then on Wednesday, probably fiscal flows added another 10. So they're right there at around 1.3 trillion. And they have a reserve, requirement of 10% of deposit liability.
Yeah.
So if you look at the H8 for around the same day, where the hell is that? Liabilities, hold on a second.
So they literally, in their own actions, took reserve balances down below their own mandatory threshold, potentially putting the whole entire banking system into a situation of non-compliance, right? I mean, like, it's ridiculous. Bunch of idiots.
Oh yeah, because what I was going to show you in the in the H8 that week, system deposit liabilities were bumping up against 13 trillion.
Right.
So 10% of that is around 1.3 trillion.
Yeah.
And they're right there. And the thing is, what they am I back? I'm back.
Yeah. Back.
So what they'll do is say, the way that they explain that was like, well, liquidity must have dried up.
I wonder why.
Well,
You're the one doing it.
So
Idiots.
do they really know what they did? That's there's no mea culpa.
No, there never is. There never is.
How do we know that they actually know what they're doing unless there's a mea culpa where they would say, and if you think about the time leading up to that, where they were reducing, it was so-called quantitative tightening, they call it.
Right.
And they're reducing system reserve balances by 50 billion a month, letting, the Treasury redeem these securities, absolve them of the Federal Reserve liability, so that nets to zero, and then those factors come down, so system reserve balances come down. And then they're saying, well, yeah, and then Trump's getting all pissed off because they're not injecting high-powered money, as they call it. And then
yeah, that was Kudlow. Kudlow always says that.
Yeah, high-powered money. So why wouldn't they say, well, we're going to have to stop because we have a 10% reserve requirement? But they were talking about that survey. Remember, you said at the time they did a survey of all depositories and said, well, how much reserve settlement balances do you think you would need?
Yeah, 600 billion.
600 billion.
Yeah.
So they're saying, well, they referenced that themselves and said, well, we did a survey. I think Powell was saying we did a survey, 600 billion. So, we can make this a lot lower, but they should have said, but we have a 10% reserve requirement. Loans create deposits. The banking system is creating new loans. Loan assets are increasing. Deposit liabilities accordingly are increasing. We're going to have to stop this at some point so that we have the 10% plus the regulatory margin, maybe 11% or something, maybe around 1.4, and then we're going to have to increase it accordingly as credit grows or something. They never said anything like that. They never said anything like that.
No, they never said anything. You wonder if they even know. And now we can fast forward to March of 2021, when the supplemental leverage ratio, which is another thing that you pointed out like years ago, and how that ratio was, so critical, also in as a factor in, reserve add and reserves going down. They said, okay, now we're going to re-implement, because remember that was suspended during the pandemic. I think in March or April of 2020, they suspended the supplemental leverage ratio, which basically causes the banks to, have a certain amount of capital relative to the amount of assets. But then in March of 2021, as the Fed was continuing to add 120 billion a month in reserves, the Fed said, okay, now we're going to re-implement the supplemental leverage ratio, knowing full well that they were going to be, dumping reserves onto bank balance sheets and throwing them, out of whack with that leverage ratio. They weren't going to be able, either they were going to have to raise capital or significantly slow the rate of other asset accumulation, let's call it loans, right? I mean, that was another one of these crazy situations where they put their own system into jeopardy with like ridiculous, idiotic policy.
Well, in the first week of April of 2021, they did raise capital. They raised, all of the major,
right.
It was probably
they had to, right?
Well, right, because the leverage ratio was suspended for almost a year. And then after March 31st, it went back on. So what they did is they raised capital. They had to do that.
Yeah.
And then they also started to promote or utilize this reverse repo facility, which they created more access to a direct account at the Fed for they're
Money
saying
markets.
money market funds, so that US dollar savers through these money markets could get direct access to the Fed like a bank. So these money market funds are becoming more like a bank for now. And now there's there's $1.5 trillion in that account. If that facility wasn't available, all of those $1.5 trillion of US dollar savings would have to be, I guess, in deposit accounts.
Yeah, in the system,
banks,
right?
and it would just, we'd be beyond Thunderdome.
Yeah, that's a good, and we've spoken about that privately, but let's go over that, because you had a great insight on this with respect to the 2008, the great financial crisis, where you noted the big reserve ad at that time, which was the Fed's response to whatever you want to call it, the mortgage crisis, meltdown, or whatever. That was really the trigger that caused the crash, right? Why don't you talk about that?
That's my hypothesis, where I think at the time they did that because they, the thesis, like, quote, banks lend out the reserves. Okay. I think that was believed at that time, but I think since then, some of that thesis has lost advocacy. But at that time, I think they thought that they could help the credit crisis,
yeah,
by injecting money.
Well, you had the Lehman failure, and I think they were worried that, the whole system was going to seize up. Banks and financial institutions couldn't get, short-term overnight liquidity and stuff like that. It was seizing up anyway, but.
But they caused that Lehman thing.
Yeah.
Because they couldn't because Lehman was a broker dealer. So they relied on bank financing, or they relied on financing. And then when the credit, if the Fed comes in and I think they put back then, it was smaller numbers, but I think the leverage ratio was also was lower, like maybe 3%, where now it's 6 or 7%. So they put in 200 or 300 billion in September, and then everything went, it didn't matter. Like the Lehman people were saying, well, we have treasury securities as collateral. But at that point, it doesn't matter, because they don't have authority to lend against any collateral. So they couldn't get funded, and then it all went bankrupt. And then it didn't, they fixed it pretty quickly, because they put 350 billion of capital into the banks. So, at 10x, that could accommodate, because that TARP or whatever, I think there was 2 increments. It was 700 billion, and they did half, so it was around 350 billion. So even if you look at the SLR as 10x, that could cover $3.5 trillion worth of new bank assets. So that immediately was fixed.
And TARP, that was the genius idea of Hank Paulson, who in his book, he was Goldman's, CEO. I mean, he in his book, and he's the master of the universe, right? The Wall Street master. He wrote in his book, he went home with his wife and he prayed, like, what are we going to do? Like, this guy's supposed to know what to do. Like, come on.
He kind of got effed by the Fed, like where, well, I don't know. Those guys are kind of just figureheads or whatever. I don't know what they know technically. They're supposed to have people working there that know what's going on. And I think the Fed thought they were helping by
they always think they're helping
injecting money.
Yeah.
And it ended up putting the banks in regulatory failure. So now, and then that's the same thing that happened in March of 2020 at the onset of the pandemic policy. they did it again. And they put in, I think that 1 week in the middle of March, they added over $1 trillion of reserves. Remember that? They were adding like a billion a day or something.
Yeah,
And
no, that was.
the market just kept going like, bam,
Well, this
bam.
this also, and it's something you've spoken about many times. This myopic, single-minded focus on monetary policy. Like I still get a kick out of this every day. Like if everything, commentary, zero hedge, the talking heads on CNBC. It's always monetary policy, monetary policy, monetary policy. And my view is really it's kind of irrelevant. The rate setting is price setting. It's just a redistribution of income. One cohort in the economy is going to make some more, one cohort's going to make some less. If anything, rate hikes, their fiscal expansions, because necessarily the government's going to end up paying more interest. So it's an injection, all else equal. And, you could tie this in now with the whole discussion of, we're going to raise rates to squash inflation. I mean, I even made a video the other day, this idiot Peter Schiff, who like, for years and years, he was saying like low rates is cheap money, it causes inflation. Then the other day he tweets, you sent me the tweet, he said, hey, landlords are passing along higher costs and these entities are passing along higher costs. Producers, when the Fed raises rates, it's going to pass along higher costs. It's going to raise inflation. I was like, yeah, he finally got it right. Then the very next day he said, but they're not going to raise it enough to squash inflation. Like, what the hell are you talking about, man? But
yeah, he kind of,
but the point is, it's this tunnel vision, single-minded focus on monetary policy. You and I, we always look at the fiscal flows, since a long time, and that's the key thing. That's the driver of everything.
Sure. Well, the thing where you say, well, monetary policy, it's not important. Well, it's, and I'm always bringing it up, and you sometimes get irritated. I should, like you're saying, like where like it's important because they can F it up.
Yeah,
that's sort of where I'm coming from. I know it's not important per se, but it can cause problems. It can destabilize.
It does. I think that's a better way to phrase it. And they can destabilize it. And even just their comments. I mean, you and I know, like, we talk about this, and I send out emails to my subscribers, like, whenever there's a comment, there's going to be a violent market reaction one way or another. I mean, if they say we're going to reduce our balance sheet, so what the hell does that mean? I mean, that's just like a recomposition of dollar assets in the economy. But then everybody jumps on that. Or we're gonna start doing QE. Everybody jumps on that. These are all like very emotional and unsophisticated responses. It's based on a lack of knowledge, a lack of understanding.
Well, let me see what I got here. Let me try this. I'm going to bring up the latest H8 or one of the recent.
There you go.
Hold on. So what do we have? Yeah, December. Okay, December 29th, right? This is the most recent H8. So let me go. Assets and liabilities of banks of the United States, H8 report, right? So we can watch. You've been reporting lately the increase in bank credit, right?
Yeah.
Okay.
Yeah.
So now I'll go down to the NSA data, not seasonally adjusted. So here, you're looking at loans and leases, commercial and industrial loans. I'll put them right here at the top. So now here, here, 2392, 24, 2470, popped to 2.5, 2.517. Very nice growth.
Yeah,
Over the last, I don't know, month or say the last month or two.
6 weeks.
Yeah, so now you go down here. So what's happened is they passed the debt ceiling in,
Right,
right?
right,
So now they're increasing the TGA. They've increased the rate of treasury issuance since
right,
they have the authority to do that now.
right.
And they're increasing the Treasury General Account and MMT 101 Treasury issuance is a reserve drain.
Reserve drain.
So you go and you look at the cash assets right there. So you see here, I mean, in November, they were 41.55. Okay.
Yeah,
Now they're down.
yeah.
That
Look at that.
reserves are in there. Reserves are considered that, cash asset.
And let me interject something here because you're pointing out something very, very important, because as we mentioned earlier, that the belief out there, the widely held belief is that, they got to pump money into the system so the banks can lend it out. And here we see the exact opposite phenomenon taking place, that as the cash assets are drained, the banks are able to lend more because it frees up space on their balance sheets to take on other assets. They want to lend. I mean, that's their primary business. But when you're dumping all these reserves on their balance sheet, it constrains their ability because, of SLR and these regulatory. But we see it right here in the numbers. I mean, you pointed it out very well.
Well, what's going to happen? Like if they could replace those reserve assets with loan assets, okay?
Right.
Because if you look at the residual, which is sort of
Going up.
a proxy, well, it's at least steady.
Yeah.
Like it's not the residual, which is sort of a proxy. It's assets minus liability. That's the formula for capital.
You're looking at not seasonally adjusted. On the seasonally adjusted data, it's actually at a record high.
Record high, but this is NSA. The residual assets minus liabilities. It's here. It's 2027. It's 2028 in November, and it's 2027 now. So that's so there. Your bank capital is staying constant, and your regulator is removing reserve assets.
Right.
So what are you going to do? Now you have the authority to replace those former reserve assets
with loans,
loan assets.
Right.
And that's the purpose of a bank, to provide credit. So think about it in reverse. What if they come in and they throw a bunch of reserves in there to lend out?
Yeah.
Crashes the whole effing thing.
Yeah. I mean,
so that's where you get those 40% down. Every time we have one of those 40% crashes, you go back and look at this, they whatever, to them, in their terms, they injected money, hundreds of billions, if not trillion, and in a very short period of time, and crash the price of risk asset, other assets, because the capital stays constant.
That would have happened in March, April 2020 when the pandemic hit, and their response was to add massive amounts of reserves. But what was different that time is they suspended the SLR.
May 15th.
We went straight up. The market went straight up, where it would have went straight down or kept going down had they not suspended the SLR and they kept on adding reserves.
Right, because so that it didn't matter because the regulation was suspended. So
now, remember, we got going back again to March 2021 when the SLR was going to come back into effect. Who was the main opposition to keeping it suspended? It was Elizabeth Warren, right?
Oh yeah, her and Brown. The chairman
Sherrod Brown,
chairman of that committee, they're generally against it. They would like to see, they default towards conservatism in bank regulation. So the more, like, they don't want to see any what they would perceive as some sort of relaxation of regulatory, they don't want to see relaxation of any regulatory regime. So, well, whatever. So they came up with this workaround with the RRP, and they're offering that to US dollar savers. Many other side of would look at it as like the people that are lending the government money. They're savers. The treasury securities are savings accounts.
Right.
So they're offering another account at the Fed through the immediacy of these mutual funds to US dollar savers, other than keeping them. The only other place it could go is in a depository, and they don't have the cap. They don't have the amount of high quality liquid assets to support an additional current $1.5 trillion of US dollar savings in the depository system. They don't have it. So they got it, that amount right now. It's kind of an emergent issue with what we see currently with the Fed talking about the interest rate policy versus the reserve balance policy, or so-called balance sheet policy and asset purchases, where they what I'm thinking is they're going to pivot from rates to reserves after the first increase. There's a possibility.
They'll do an increase, and then they're like, okay, we're going to hold it there, but we're going to reduce the balance sheet.
They're going to start pumping that. We got to watch for that, and that's a good thing, because having having all of those balances in that RRP account, where right now where the interest rate policy is stable, right? It's working. But they're going to destabilize that by increasing interest rates. And they have all these rates. So to me, it creates a potential, it's a risk that they screw that up. And then they create some kind of financial incentive where no one would go to that RRP anymore. You see, like a US dollar saver would say, well, gee, I could get, you're only offering 0.1% in the RRP, and I can get 0.3% in a 30-day treasury. So I'm not going in there. I'm going to just go buy treasuries.
Yeah.
And then all of those, those treasuries settle in the depository system, and all those settlement balances,
that's
1.5, potentially 1.5 trillion of settlement balances could come rushing into.
That's a good point. That's a good point.
That's my concern. And I'm not saying that's going to happen. I'm saying that they better be careful. And what I would do if I would get rid of that. If I would get rid of that RRP balance. I would just remove assets, let assets run off.
Yeah.
So that goes to zero. That'll be the first thing that reduces. That'll start going down. And then when it got to zero, I would just say, whew, that we might have dodged a bullet there.
It's something that nobody's really paying attention to. That's right.
Well, they have to be careful. They have to, and I'm not saying I'm seeing increased mention of the balance sheet now. So they may start to increase their rhetoric, and they may start to increase their rhetoric about the balance sheet, and that would be a good thing. Bring that down. Leave rates alone.
Well, Powell seems to be very pliant when it comes to, like criticism from Wall Street or the financial media or whatever. He seems to, fold under that pressure. I mean, we've seen it. We saw it previously in late 2018, where he switched policy around from rate hikes to rate cuts, because everybody was complaining that the market was correcting, and then we've seen it recently too, with this flip-flop on inflation. As a matter of fact, we talked about this. I think the very day he kind of jettisoned the word transitory was the day that most commodities peaked out and started to crash. Like you had a view, which I still think is the correct view. I think it is transitory, and I think, we're starting to see some relief. I mean, I've been talking about C&I loans increasing for the last 6-7 weeks, and those are primarily used for inventory finance. And, the fact that they're increasing says to me that companies can source inventory now where they weren't able to before, even if they wanted to. Even if they wanted to go to the bank and get a loan, there was no inventory to procure because of the supply chain issues. But now, you just showed the numbers there that those C&I loans are going up. But Powell flipped on the day, really, that everything came crashing down, and that shows how he's swayed very much by the financial media and criticism from Wall Street, even politics. We don't know. I mean, you suggested possibly that he had a meeting with Biden. Maybe they were talking about his reappointment, and Biden maybe said to him, "Look, you got to do something about inflation because this threatens our, the midterms. This threatens the midterms for the Dems."
Well, all of this has political implications. So I think he did, it's the number one concern in the polling, or it was the number one economic concern of people. Well, I would say before this recent surge of coronavirus in November and December, inflation was the number one economic concern of the voters. So, they're going to react to that and say, you have to do something. So he is, but I think what he could do, even, it's hard to read, can't read their minds, but if they were to come out and say, well, we're going to reduce the money supply aggressively, which now they're talking, the fellow from Atlanta, Bostic, is talking about, he's floating 100 billion per month, which would be I think it would be perceived as substantial, bringing the balance sheet down, so-called balance sheet down by 100 billion per month, and then just start talking about that, we're taking the money out, we're pumping out the money, blah, 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 and kind of just put rates on the back burner. It might be a good compromise. And then,
that would be so cool if they pump out the money and the economy just like blows through the roof, right? Because bank credit expansion.
well, you're not, you
whatever happened, they're on printing money and everything's going up.
Well, it would not be, you talk about contrarianism, it would not be perceived that way. Everyone would think it's going to crash.
Right.
And it's that the opposite, a quick, an impulse of reserves is what causes the crash. That's what causes all these crashes.
But they still would not connect the dots. They would ascribe it to something else. They would say, "Oh, it's going up because you see he squashed inflation," or something like that. Yeah, inflation probably wouldn't even come down very much. Again, if they're raising rates, but they would never connect the dots that is the reason why it's happening. Like, you're pulling all this cash out, you're creating a credit boom, the economy's going up on that. They would not connect the dots. I assure you, they would not connect the dots. They still wouldn't.
You mean the public or
the public, the analysts, the mainstream of the economics profession? They would not.
Well, look, when I go like this, if I put my share screen back on, right, and we're looking at these numbers, like here, it's like here, I'll zoom it out, like here, okay. Now we're looking at that, right?
Yeah.
Is that interesting? It's interesting to me. I mean, I like numbers, and I like looking at charts, and then, but they don't want that. They want things like pumping in the money.
Yeah.
You got to pump. You got, like, it has emotion or something.
Yes.
Where this is boring. You think about that. What was that movie about the crash in 2008, like The Big Short?
Oh yeah. That was a great movie.
Okay.
Inside Job, whatever.
Yeah. It's like who was in that?
That won the Academy Award for documentary.
All these movie stars are in that, or whatever. They're not but
Oh, you're
wait,
talking about
wait,
a different movie. You're talking about, yeah,
Chris,
yeah, the Big Short. Was
yeah,
that it?
it's like
Yeah,
Christian Bale, Matthew
yeah,
McConaughey,
that's the Big Short. Yeah.
it's like these big stars and everything, and then so now millions of people go to see that, and but no one's going to watch this, Mike. No one's
No,
going to
no,
like what like me and you going like, well, look here, you can see, look, here's the deposits going
yeah,
down,
we'll have
and
like
here now
no.
you're gonna here's your reserves. Look, as reserves go down, like that's not
No, no, no.
it just it's too
Puts
arcane,
people
it's
to sleep.
too but that's what has to be done. I mean, I'm sorry, but that technical work is not entertainment. It's they all want to go out and entertain or something, and
Yeah, yeah.
they create these emotional statements like pumping into money or
Juicing, they're pumping.
using and what they're reducing the regulatory ratio and they're causing a credit crisis. I mean, from a so that, but here somebody has to do this, and I think that's what probably the Fed is supposed to do.
No, they're not going to do it. And then
They're not
no, because
not and it I think I agree with you that the public is not gonna, they're
no,
not
they're
gonna
never
get
going
it.
to.
But the Fed maybe, because they did suspend the SLR. Why they do that? Like there has to be, they had to have a reason behind why they did that. It was never asked of them why they did that, but they did it. And then they did create the RRP. So
Yeah.
they moved balances over there.
So
And now,
somebody in there is figuring some stuff out, I guess, but
yeah,
they're very inept at communication in a way that the public understands. And we even saw, you sent me that tweet yesterday when Powell said the debt is unsustainable. We got to do something. Here we go again. It's so disappointing to hear that crap. Like, especially now, like, MMT's been, it's in the mainstream. It's a lot, it gets a lot of coverage, a lot of attention, whether you follow it or not. I mean, it's expose things that are truthful. I mean, that are reality. And then for him to say something like that is just fucking,
well,
that's
maybe,
unbelievable. That was really disappointing.
well, maybe like he's at this hearing, and
Yeah, he's pandering to these
he-
senators and these politicians. That's what he's doing.
right.
He's pandering to them, and it's just, that's just wrong. Like, you need to explain this shit, the way it really is. And once you start pandering like that, like, you just reinforce these myths, and they just become stronger because, hey, he's the Fed chairman. He's saying this. It must be true.
Well, I think he's there getting hit. He's sitting there. There's all this panel of these highfalutin poobahs, and then they're all hitting him. What are you doing about this? What are you doing about that? What are you doing about this? And then this is an opportunity for him to kind of like get one back at them. Like, yeah, well, you ought to balance your budget or something, or what about you doing with the deficit or something? I don't know. It's just a way to get a shot back in or something.
Well,
I don't. It's a defensive thing because
Greenspan. That's one thing you got to say about him. He never did that. He had his own way of communicating, which was largely inscrutable. Like, you didn't really. He had this kind of mumbo jumbo talk that went over everyone's head. And the famous clip that I always kind of put up every now and then was his interaction with then Congressman Paul Ryan, when Ryan asked him, well, should we privatize Social Security to make it more secure? And he's like, well, it is secure in the sense that the government can create as much money as it wants and pay it to whomever it wants. The question is, will the real assets be available for that money to purchase? And you could see the look on Ryan's face. It was like it went right over his head. He was like, huh?
he's a political science major. He's not no training in finance. I don't know. They just don't get it. They work. In politics, it's that emotion. It's that.
But
that
Matt, what about Neil Kashkari, who's what is it, Minneapolis Fed president, who, like he said, when the personal savings blew to 6 trillion, because we had massive deficit spending and the government sending out checks to people. He's like, yeah, well, I'm not that worried about the economy because the savings rate is so high because we didn't go to movie theaters and restaurants. And I'm like, well, what if we didn't go to movie theaters and restaurants? What happened to the savings and the income of the movie theater owners and the restaurant owners? Like, this is just very logical stuff that it went right over his head.
Well, the savings happens first.
Yeah.
Well, the government spending
Yeah,
happens.
spend it. It's the only way.
And then it's saved. like to keep some savings is keeping. To keep something, you first have to be given it.
Right.
You know, it's just like draining the tub or draining.
Yeah, you can't drain it unless you fill it up first.
So it's not a chicken or the egg situation. It's not a chicken or the egg situation. It is that happens first. It has
to. Just by pure logic, it has to happen first. Anyway.
Yeah. So I don't think what the Fed, I saw something, I couldn't find it on their website, but somebody tweeted it out that I follow. And they were saying that they're going to start this new series at their Liberty. The New York Fed is going to start something at their Liberty Street Economics blog over the next few months. So I'm kind of hopeful that maybe what they're going to do is sort of try to transition people if they understand. They suspended the SLR. They have the RRP going. A lot of them have been talking about bringing the system balances down. So these are all, to me, these are all good developments. These are indicating to me they could be getting some understanding, but it's so radical that maybe they have to kind of like let them down easy. You know what I'm saying? Like they can't just come out and say, like maybe me or you would say, like, well, fuck, shut the fuck, shut the, you monitors idiot, like they can't do that. They have to be more political about it. So they have to kind of let them down easy. Because how do you tell people that for decades have been saying, oh, you got to inject the money so that the banks can lend it out? Like, how do you tell them, like, that's completely wrong? It's.
But I do think many of them really believe that. I still think they believe. I get asked this question a lot. People say, well, Mike, do you think they believe that or they really don't know? And, I always use that anecdotal story about David Stockman when I met him at Fox News. And, he was the budget director. He's an educated guy. And like he was saying, he was complaining about, rates being too low and this and that. And then, I tried to explain to him, well, that's what the Fed does. And then a couple of months later, he's back at Fox News and he was complaining that rates went up or something like that because the Fed raised them. And I said, David, last time we spoke, you said the Fed, it was not their control. It was like China lending us the money. So I think they're clueless. I think really they're clueless.
Well, they're taught that, in the schools they go to. So, like maybe like University of Chicago or something like that.
Yeah, terrible.
You would go there, you get a 4-year degree. They're teaching you, monetarism or quantity theory of money. Maybe you get a master's degree, you go another 2 years and they're pounding this thing in. You work hard, you get out of that, and then you're proud of your accomplishment, and you're not going to turn your back on that.
No, right.
Not easily. Many people will just dig in. But if the Fed, I'm saying as the regulators, and remember, Powell's like a lawyer, he's not a economist. He's
right.
He's an attorney or jurist. He doesn't have a dog in that academic fight. So he may be telling them, turn this thing around. We have to do what's right. So, but they have to kind of massage it and cajole, like transition it over.
They have to finesse it. Yeah.
Finesse it. They have to let them down easy. And that would be, so I look forward to this series, this blog. They call it like ample reserves or hot or environment of ample reserves or something. I don't know. But at the same time, they're talking about severely reducing them. So I don't know. See, the problem is if they don't mea culpa, Powell could leave and someone else could go back in there behind him. And it could all just go right back to where it was. And then, someone would come in and be a crisis and like, oh, pumping $1 trillion.
Well, Powell's on for another 4 years. But I think there's some new FOMC people coming on that Biden just nominated.
Yeah.
I don't know what their positions are, but they're usually from the same academic background as all these people. So you can't expect too much from them. Before I let you go, let me, because I want to ask you have a kind of a very bullish outlook for the fiscal, this year. I'm seeing fiscal slow down. Not precipitously, it's not like a real crash in the fiscal, but it is slowing down. But you said you're looking at like a 580 billion monthly flow. How do you come up with that?
Well, I think, I just looked at.
Actually, you said you're looking for a 600 billion.
Yeah, around 6, but maybe 6 times 12.
I mean, we're not doing that right now. We're lucky right now if we're doing a 500 billion monthly flow. Well, where you come up with 6?
Well, I looked at first quarter and it was I don't know, like maybe I think first quarter average
590 or something like that, or 580 or something like that.
Yeah, and then we're gonna get this.
But we had the child tax credit in there payment.
Right, that's 15 billion a month or something. So, but they have a 6% lift in Social Security, Medicare, federal salaries, military pay, government service.
6% goes for military pay and all that other stuff too. I thought it was just Social Security.
No, I think that
they all have cost of living adjustments then, right?
Yeah. A lot of these things are based off the CPI, and this was a good CPI year. So anything that uses CPI is going to get a pretty nice increase. So, plus the fact that many of the appropriations have gone up, but we are still though, Mike, you're right. We're still operating under that continuing resolution.
Yeah.
So that limits things.
February 18th. I mean, will they ever come up with a full year budget?
I don't know, but I just saw something that there's Steny Hoyer is looking at another stimulus bill.
Yeah.
Because look, this COVID thing yesterday was like almost 1.5 million cases.
Yeah.
So now that's 5 days out of work. You know what I mean? So we just lost, because the CDC protocol is if you get a positive test, you have to quarantine for 5 days at least, and then you can go back with a mask if you're not symptomatic. But so let's say at least 5 days. So yesterday we just lost 1.5 times 5, that's 7. But we just lost 7.5 million man days yesterday. Like 3,000 people called in sick at United Airlines in one day. So this just started, I would say, after, right around Christmas week and into the New Year's week, and now it just keeps going up. So this is going to, I think they're seeing this is going to be another hit, and they might, look at the airlines. What are they going to do? If they're not flying, they're not making money. They got to make the payments on the aircraft. They're going to need another airline bailout.
Yeah.
Maybe not as big as the first one.
They're talking about restaurant stimulus, something like that.
Nobody's going out. The food, you could see people aren't, the food in the stores is starting to come down because they lack drivers and warehouse, logistics employees at the stores and stuff to offload and stock shelves and whatnot. So, this is going to hurt first quarter. We'll see how long it goes. We're only in the second week of January. Maybe it'll roll over pretty quick. But, the last one in 2020, they didn't really shut everything down till March. So
well, as you know, man, my friend, I watch those flows every single day like a hawk. So I'll see what's
well, it is. I agree with you. It is right now. It doesn't look as robust as I think it will turn out to be. But we're going to get, just watch for that the CPI to kick in. That's what you want to see. And then maybe we get some, targeted stimulus here and there. and we could be back up close, at least close to 6. But
That'd be, wow, like
600.
incredible conditions, fiscal and banking
Yeah.
combined. Wow, wow, wow.
And then they'll be they're increasing the TGA right now by hundreds of billions. That's going to reduce reserve assets. And then pretty soon, they say sooner rather than later, after the first rate increase, they're going to be reducing the balance sheet, which also is a bit of now if it just comes out of that RRP, it's kind of not, it's not as powerful as if they were taking it away from the depositories, but it's still helpful. I think it's going in the right direction.
Well, I'm looking at markets today. We're up again today. So no, the last couple of days, I've been telling everybody to cover their shorts in the defensive positions and get long again. So
That was a
it's
good
looking
call.
good.
That was a good
Listen,
call.
buddy, it's been great talking to you,
Yeah.
man. Finally get to see each other.
Yeah, I'll make it up to New York sometime.
All right,
Have
cool,
lunch or
man.
something.
All right, better let you go. Thanks a lot.
All right, thanks, Mike.
All right, man. Take care.